This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome to a very special edition of the Fintech Takes podcast. I recently had the opportunity to attend MX's Money Experience Summit in Park City, Utah. It was, as always, a great event, and I'm grateful to the folks at MX for inviting me to speak. I'm also grateful to them for humoring my request at the last second to record some podcasts live from the event, which is one of my absolute favorite things to do. There's just something better about recording interviews with folks when you're talking to them face to face, especially when you're in a setting as beautiful as Park City, which was absolutely gorgeous this time of year. So that's what I have for you today, a series of short conversations with various speakers at the Money Experience Summit. Now, I'm going to give you a brief intro before each interview begins so that you know who I'm speaking to and what to expect. First up, we have Ashwin Vasan and Kelvin Chen. Ashwin and Kelvin are both ex-CFPB. Ashwin is now a senior advisor at FS Vector, and Kelvin is the head of policy for the Consumer Bankers Association. And they are two of the first people I turn to whenever I have dumb questions about financial services regulation or public policy, which, as they will attest to, is all the time. We covered a lot of ground in this discussion, which, full disclosure, happened before the CFPB released its final rule on open banking. And while it might sound at times like we're being a bit harsh on the CFPB, trust me, it comes from a place of love. So, here's my conversation with Ashwin and Kelvin. Okay, well, welcome to a very special edition of the Fintech Takes podcast. My name is Alex Johnson, and we are recording this live from the mountains of Utah at the MX Money Experience Summit, and I am delighted to be joined by my fintech friends, my bank nerd friends, Ashwin Vasan and Kelvin Chen. Guys, thanks for joining me.
Thanks, Alex. I'm a big fan of the podcast. I'm excited to be here.
Great to be here.
Awesome. Well, I'm thinking of this in my head as a CFPB party podcast, which is ironic because I realize that neither one of you work at the Bureau anymore, even though you both did at one point. So maybe just for context, if each of you could give a brief intro and background. And Ashwin, why don't we start with you?
Yeah, absolutely. So I spent a total of 8 years at the Bureau in two stints. The first was with Kelvin in the early years, standing up the agency and getting it up and running, working on the mortgage rules and a bunch of other things. And then left, went to private industry, and came back with the Biden administration and spent the last 3 years there, overseeing a group called RMR, which kind of does most of the policy-making work, the reports, and the research. Currently a partner at FS Vector. It's an advisory firm for fintechs and banks and on regulatory compliance and public policy and a whole bunch of other things.
Awesome. Well, again, thank you for coming on the podcast.
Of course.
I feel like we've done lots of podcasts without recording them, so this will be fun. And then Kelvin, same, but if you wouldn't mind giving an intro for yourself as well.
Sure. Thanks, Alex. So I started my government career at the Federal Trade Commission doing consumer protection work, was at the CFPB with Ashwin in the Rich Cordray days, went over to the Fed to work on some of the issues we're going to talk about here, actually, and then went over to the private sector. I was in-house at a couple of big banks, and now I lead the policy work for the Consumer Bankers Association. We're a trade group that focuses primarily on retail banking issues.
Well, for those who haven't read every single one of my newsletters, I did write one in which I gave out fake advocacy awards for good policy work, and Kelvin did win an award, which is like the least prestigious thing you could possibly imagine, but you are doing wonderful work over with CBA.
And we're going to make that a black tie event next time, right?
That's my hope, is that like eventually like I'm up on stage, we're all wearing tuxedos, so give it a few years, but there actually will be real, I think I call them addies, so.
No, I don't have my diplomas on the wall, but I have my Addy printed out. That is, I'm so proud of that, and so I thank you so much for that.
No, absolutely. So you guys are the perfect folks to quickly hit a couple topics that I'm curious about. I think given the fact that we're here at the MX Money Experience Summit, open banking would be a good place to start. Obviously, we're getting close to the final rule being released. I've heard varying reports as to when and where it might be released, but we know sometime in October, it's the result of years and years and years of work. And I've written and talked on the podcast extensively about the draft rule, which we've seen, and all of the comments submitted by industry, submitted by consumer advocacy groups, by, I think there were like 11,000 comments. I didn't read them all, but there were a lot. And have been trying to follow along with, I think, the work that the Bureau's been doing to finalize the rule and adapt maybe some of it to the feedback that they've been receiving. And I was just curious to get a quick read from both of you on, when you think about the final rule compared to the draft rule, which we're going to see relatively soon, what is one thing that you think either might change or that you think you're sort of hoping will change? And you can go either optimism or you can go more realism, but Ashwin, why don't we start with you?
I think in my mind there are probably 4 or 5 things that might change marginally, is my guess. So for context, I worked on the proposed rule and since left, so don't have much of a sense of how the Bureau is making these final decisions. But I think there are probably 4 or 5 areas where I think you might see a little bit. I'll just pick one. I think it's the secondary use restrictions.
Yeah.
There's sort of, I think the broad intent of third parties that use consumer permission data not using it for resale, for use cases that are sort of very far away from a consumer's intent, that will stay, absolutely. I think drawing that line is really tricky, and I think there's been a lot of debate around, can I use the de-identified data for research? Can I use the data for building and backtesting fraud and underwriting models? And I think you might see a little bit more space there, but ultimately it is a deliberate shift from you can disclose all of your data use cases, and then therefore, in the fine print, if you say I sell it to Facebook, and
I checked the box.
I checked the box, right? And then you never have to worry about it.
Yeah.
It'll always be something of a reasonableness standard
Yeah.
in terms of what that reasonable consumer intended when they put their credentials in and gave you access to their consumer data. And so, there'll be some carve-outs, some sort of areas that kind of give third parties and fintechs some more comfort, I'm guessing, and specificity. But at the end, I think over time, as the rule is implemented and enforced, you'll probably get more clarity on what that line is. And that's a new thing for data protection and data privacy.
Yeah, absolutely. No, I attended an event where Director Schoper spoke, and they asked him specifically about secondary data, and it was really interesting because he said something to the effect, and I'm paraphrasing here, but it was, we're going to draw bright lines, and then he said something to the effect of like, and reasonable adults can make their own decisions about what to do there. And so it was really interesting because I think, to your point, he's definitely heard the feedback on secondary use. And I think the fact that the feedback came not just maybe from the quarters that the CFPB were expecting, but maybe other quarters as well, helped kind of drive that point home. But at the same time, I do agree with you that secondary use is a priority in terms of reining that in. And that does seem like maybe we'll see a little wiggle room, but not as much as some may be hoping. Kelvin, what's your take on a thing that we might see change?
Yeah, and by the way, I'm glad to hear that there might be some clarification on secondary use. I think the notion of, I know when I see it, is a cute thing to say, but in terms of people trying to build business models around it, if you can't actually put it in print and explain what those things are and where those lines are, it's really hard to build, multi-billion-dollar businesses, or more importantly, put consumers in the front lines there. And so, I do worry that, at least in the proposal, you could have someone say that my primary use is improving consumers' financial health. Right. And then dragging everything underneath that.
Right.
So it'll be interesting to see how they kind of clarify that. On our side, this is hyper tactical, but I expect the Bureau to loosen up on the compliance timeframes.
Yeah.
So you may have already talked about some of this in the earlier podcasts, but the original proposal had very large financial institutions having to be effective within, I think, 6 months upon release. And that's just, we had people writing letters in saying that they're then already having to do implementation work without knowing where the rule will land, just given how long it takes to not only implement, but then run things through compliance testing and risk management and to train your people. I'd also note that a lot of the political tactical advantages of that tight time frame have kind of elapsed given how far the rules come out, right? So generally you would only jam industry like that because you want to make sure that certain people are effective, or certain people are compliant, which makes it then harder for a new administration to change the rule. But because this rule has slipped into late October, wherever it lands, whatever, even 6 months from now, there could be a new administration, and so there's just really no advantage for them to keep it so short.
That makes sense, and I think the other thing that's tied to that is a very reasonable critique is that we still actually haven't gotten a official designated standard setting organization, and I think we can all sort of make an educated guess as to which organization is going to end up in that role. But it's hard because if you don't even know what the standard is you're building to, the closer that deadline gets, the more it's like, we don't even know like technically the specification we're supposed to be using. So I think that's a very reasonable guess. And I love your point about sort of the political considerations that go into that at various times. But in this particular case, it doesn't seem like that's going to be an issue. And it's a good segue actually, because the other thing I wanted to ask about is, what do we think the reaction from industry is going to be after the rule is finalized? And as you noted, we're headed into an election. Who knows what's going to happen? My sense, just in a broad sense, is that the idea that consumers own their data is a pretty bipartisan idea at this point, and that, well, I'm sure the Bureau is very focused on trying to get this done before this administration kind of runs out, that regardless of who's in charge next, some version of consumer permission data rights are going to exist for a long time. But I mean, Kelvin, maybe I'll start with you. Do you anticipate any significant pushback on the industry side? Do you think we'll see lawsuits over the final rule? Like, where, from a temperature perspective, where sort of are you right now?
Yeah, I can't speak to the lawsuits, Alex, just because we'd have to see what the rule looks like.
Yeah.
But, and I also have to cabin this in that I've been an outlier voice on this for the longest time. Like, this rule is partially why I left the Bureau, actually, because I left the Bureau because I felt like the Bureau had overreached, went to a prudential regulator. So when one of the first things we did was wrote a speech saying, hey, like, this is more complicated than you guys realize. So, whenever I'm meeting with industry, I'm always saying, why are you, to banks at least, there's a separate rule for non-banks. But for banks, I say, like, why are you not out there flipping cars over on streets on this one? So there's a lot I have to say, if you don't mind.
Oh, please.
So one, you can be highly supportive of consumer ownership of data rights. You can be highly supportive of an open banking infrastructure and be building towards that and still think this rule is bonkers, right? And so I would note, like, a lot of our members are building towards open banking tools and building towards APIs. There's 1 billion calls a month on these APIs already. And so I want to kind of, if possible, cleave concerns about the rule from trying to usher in a new age of open banking for the industry. And I think that's often lost when people talk about the rule.
That's right.
Yeah.
But then when you talk about the rule, I think one of the questions then is, if you care about open banking, and in my mind, if you care about the legitimacy of the Bureau, does this rule further that? And I don't know that it does. I mean, to begin with, there's a question as to whether or not the Bureau has the authority to do this.
Sure.
So if you look at the plain language of the statute, right, it's a pretty narrow statute that's really, Alex gets to download an Excel file of his latest transactions. It says nothing about APIs. It says nothing about delegation. And it says certainly nothing about payments, which is where we're hearing a lot of the CFPB move towards. But then when you think about some of the things that are baked into the rule, right, like the rule is hyper-specific in a rule about there being no fees, about technical requirements like uptime requirements, about down to the millisecond, about ping times.
Yeah.
And it's just, with so many open questions, not even one standard setting body, but as I read the rule, there should be a couple of standard setting bodies that should be up and running by now. And so to be that specific about, like, down to the millisecond as to ping time, not knowing where the world will land, and requiring a new rule to act like a whole new 10-year process to change that, while also leaving huge unopened questions, like unanswered questions, like how do you handle secondary use, or things that aren't even in the scope of the rule, right? Like actually doing screen scraping, or actually like addressing the liability question.
Yeah.
It just seems super problematic as a whole. And so, I think people are starting to realize this. Part of this is like there's a salvo of a lot of other rules that are hitting, but as people are realizing, oh gosh, like this thing is coming, and it just seems awfully half-baked, like I think people are starting to then say, gosh, how are we actually going to deal with this?
Yeah. Ashwin, anything you want to add there?
Well, I mean, I think a bunch of reactions. I think first, how will everyone react? I actually think everyone will kind of more or less mobilize and start thinking ahead,
Yeah.
right? I think that whenever you do a rulemaking, you sort of freeze everyone in the process, and it's one of the unfortunate consequences of rulemaking.
Yeah.
Because everyone feels like everything will be, the fact that you started this off by saying, well, some people are saying this date and that venue, actually none of that matters, right? We all know that, but it's our way of controlling the uncontrollable, right? Like if we just knew which place Director Chopra was going to announce the rule, like everything would be okay. So, the rule will be announced and then we'll know the details. And then I think, by and large, I think everyone will then mobilize to fill in the gaps. I agree with Kelvin in that it is important to separate this rule from the open banking ecosystem and how it performs today.
The progress we've made towards a market-driven solution, right? I mean, like we have a very robust open banking ecosystem in the U.S., and then you should actually maybe qualify that to say open finance ecosystem because it covers a lot more than the covered data that's currently in the rules. So it's interesting.
Absolutely. And I think you said $1 billion a month. I mean, I think the rule said almost $100 billion a year, right, in terms of API calls. And in fact, I think it even suggests that it's more than all the other countries combined. So I think it's quite, or maybe at least the largest ones. So we have a very robust market-driven open banking ecosystem. At the same time, I think when we're proposing the rule, we said, look, reliability is still not, there are certain things that I think really need to put the consumer in control. And I think without getting into sort of Section 1033s and how to interpret it, like I do think at the heart of it is that consumer control of their data. And I think you can't control something if you pay for it. You can't control something if you can't count on it being there when you need it. You can't control. So there's a whole bunch of things that I think flow from that principle that are in the rule. And when we were proposing the rule, when I was at the CFPB, it was very much a principle of how do you kind of stabilize the existing system, give it more scale, take risk out, right? Transition to secure APIs, secondary use on privacy, take that risk out of the system. And also, and this is the point about the standard setting organization, encourage industry to continue that momentum towards self-governance and self kind of standard setting. Now, that doesn't always work, right? There are certain times when a regulator needs to break some ties. But by and large, I think given the starting point in open banking, I think, we are already a place where I think banks and fintechs and aggregators have come together in ways to share that data. And I do think that while all pieces of that standard setting ecosystem may not be set up, I think they will emerge one way or another and fill in the gaps and many of the things that Kelvin discussed. So I think the reaction will be positive. I do think it has bipartisan support. I think, hopefully it'll move forward on the implementation timelines. There might be some wrangling around that, and sort of details that come out that all directors of the CFPB have dealt with when implementing major rules, and I think I'm hopeful it'll flow like that.
If I could just
please,
I think the thing that's hard, and it's, Ashwin and I were on the same team in the early days of the Bureau, so you can kind of guess what my priors are here, is the faith that by creating a very rigid rule set, you will create opportunities for the market and people to then figure it out, right? Like if you think about what's taken place in Europe, for instance, on open banking, which has been arguably less successful than what we've seen in the U.S., where another data aggregator says that there's more people with fintech solutions and streaming services. They, for instance, have made the switch to realizing, we have to be able to charge the developers fees in order to maintain this ecosystem, right? Like, not only could that happen in the U.S., or this rule would forego that possibility that you'd actually have to go through a whole new norm-setting process to allow the market to answer a very fundamental question like that, where we don't know where things will go. And it's just a kind of a difference in mentality as to kind of the role in government and getting to the answers there. And again, I feel crazy saying this because what my priors have been, but just giving the market the opportunity to answer some of these questions that I feel like they're going to be so hamstrung given some of the very rigid constraints here, while also the very weird open and unanswered questions.
It is a really interesting question about just where do you draw these lines and where do you try to be more prescriptive? Because I do get the sense, reading the rules and some of the comments that there is this feeling that like we don't want to repeat the mistakes of the UK or Australia or other markets. And I think there is definitely an awareness of like, if you're overly prescriptive, you set a set of rules. And I think we've seen like in the UK, banks rub sand in the gears of open banking because they know exactly, I'm allowed X minutes of downtime per year, but you didn't specify that all that downtime could happen at one point of the year or per month. And so like the setting of specific requirements does, I think, change that. The other thing that's unique about the US from my perspective is, and this is a lovely thing about consumers in the US, it's also a challenging thing about consumers, but they have very high standards for, I want these things and I don't want you to take them away. And one of the things I noticed in the US a lot is, if you're a bank and you don't allow your customers to share your data, you get calls and complaints, right? Like when it breaks or it doesn't work. And so consumers hold industry's feet to the fire, I think, in the US much more than sometimes I talk to my friends in Canada and they're just like, we wish Canadian consumers would care more about some of these things, but they're just, there's kind of a cultural difference there in a way. So I think that's really interesting. I think the other part to all of this discussion that's just fascinating to me is, we will have to see how the private industry drive that we've had evolves or adapts under more of a formal rule or regulatory driven system. I mean, I think, Ashwin, you're making this point. I'm actually very impressed at what FTX has done around standard setting. And it's not perfect. And I know Director Chopra and others have concerns about some specific things about how the standard setting body works. But in general, I mean, I wish we had something like FTX in the world of like banking as a service, right? Like I wish we could make that much progress pulling different parties together. And I do think that, one of the things we don't talk enough about is like the other side of these issues, right? So we focus so much on like banks sharing data. I've harped on forever, I wish fintech companies would be a little bit more active in like making it easy for their customers to share data, right? And that's kind of like a quieter issue that doesn't get as much focus, but I am hopeful that we'll see a little bit more of a level set coming out of the rule, even if we still leave some room for private industry. So the other thing I wanted to ask you about it, guys, real quick, before I let you go, is outside of 1033 and open banking, which obviously we could do another couple hours on easily, I wanted to just get a sense from you, is there another thing that the Bureau is working on that you think might not be getting as much attention, but that is worth folks knowing more about or thinking more about? Because I do think some are issues, some are kind of lightning rods from a PR perspective, some are these massive things like 1033, but the Bureau is very busy right now, particularly as we sort of head into the fall. What else should we be thinking about? Kelvin, maybe I'll start with you on this one.
Sure. And Alex, I'm going to cheat. I'm going to have three, but I'll try to do them quickly.
Okay. Yeah.
The first would be this Fair Credit Reporting Act rulemaking.
Yeah.
And the main thing I would note there is, I mentioned I have this note to people that hold the data that you should be out flipping cars over in streets on 1033. FICR would be the thing I'd be asking about as to whether people that are currently outside the Bureau's regulatory purview but would be, why they aren't flipping cars over in streets. And I think, so under this rulemaking, as you know better than most, it would basically have a very expansive definition of what it means to be producing a credit report, such that a large number of businesses that aren't currently under the regulatory scrutiny or the supervisory umbrella of the Bureau would be then pulled in. That's just really huge. It's a really huge land grab. Yeah, I mean, from a jurisdictional perspective, from a norm setting perspective, it also aims to, in many ways, kind of bring about concepts of, and you've written about this better than most anyone.
I'm obsessed with the FCRA, but it's unhealthy, but go ahead.
But, and I understand the notion of like Alexander cutting the Gordian knot, right? Like, there's not the Gordian knot, right? But being able to cleave that and come up with a single federal answer for privacy, it's just, man, that's not his job, and that's not what the rule was created for. So that's the one. The other two I had mentioned would be, and it comes up in different ways. On the fair lending side, we've seen the Bureau switch the burden on an important part of the burden shifting test when it comes to understanding whether or not there's been disparate impact to consumers.
Yeah.
And so there's this multi-pronged test where you've got to see if there's a disparate impact to start with, a valid business justification, and then someone has to show whether or not there's a less discriminating alternative to consumers. Yeah. So it's super complicated. The point being is that the Supreme Court has said that for one part of the burden shifting test, the burden lies with the people that are trying to prove the case. Mm-hmm. Whether you think that's right or wrong, I'm not a fair lending expert, that's what the Supreme Court has said. the CFPB, through its supervisory process, is one by one kind of tipping banks over, saying, no, actually, that are in line with you. And the thing that is, as like an American, that is nuts to me about this, right, is that there's a process for that, right? You can't just, under the, like with all of the authority that you have in examinations and all of the opacity that you have there, like tip people over one by one. Like there needs to be a conversation about that. There needs to be notice and comment. There needs to be an opportunity to say, is this the right answer or not? We're seeing the same thing take place on the fraud and scam side, where the CFPB has in a number of ways tried to come at Regulation E to do that burden shifting on fraud and scams. And I think they've realized that their authority is somewhat limited in certain ways. They've tried kind of supporting activities in other states. But then we're hearing through public statements through banks that there are enforcement activities where the bureaus come in at a different way, saying, you know, what, we think you've got liability a certain way. And the banks are having to, like one by one, figure out whether or not they're going to agree to a norm shift that, again, that the CFPB should be having a larger conversation about through the Administrative Procedure Act. This isn't to say that they aren't well-meaning, but there's a whole law about this and for the norm-setting process, and the fact that people are having to do this behind closed doors and are at risk of their larger businesses being put at stake, it's kind of crummy and a little concerning.
Well, we could do a whole thing on fraud and scams, which we don't have time for, unfortunately, but that'll be a future podcast. Ashwin, why don't you have the last word on this?
You know, I live in a world where I'm still kind of paying a lot of attention, as does Kelvin, to the CFPB. So I don't know. It's hard for me to imagine what you wouldn't be paying attention to it. You know, it's
the wrong question for CFPB nerds.
You know, I think everything they do is meaningful. You know, and something worth watching. I mean, for people who, I think. A lot of times, I think the Bureau will, for example, release reports early on, and they
kind of signal where they're
signal intention. I think the director's speeches and his senior staff speeches tend to be very intentional in saying kind of what they think industry should be focused on, and I think those are worth paying attention to. Kelvin didn't mention overdraft, but there's a proposed overdraft rulemaking out there, and I think. Whether or not the Bureau is able to finalize that term is an important thing, and people sort of assume that the harm that consumers face from overdraft and the practices and the challenges in that market are sort of resolved. They aren't. Many of the largest institutions continue to charge overdraft, and are not actually comparable to some of their better peers. The Bureau and fintechs have done a lot to push that market towards better practices, but I think work still needs to be done there as well. But otherwise, I agree, with the FICRA rule as well. So there's quite a lot of activity. Much of it, I'm hopeful will continue but we'll see.
Yep. No, I mean that's a good place to leave it, because I think hopeful, but we'll see is probably a good way to summarize this entire conversation. Ashwin, Kelvin, thank you so much for nerding out with me on this topic. This was great, and let's do it again. I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com. Okay, next up we have Jesse Mecham, founder of YNAB, which, if you listen to Bank Nerd Corner, you will know is Kia Hazlitt's favorite fintech app. I couldn't miss the opportunity to chat with Jesse about the joys and challenges of building a fintech app in a product category that VC investors hate, the long-term thinking that has gone into the development of YNAB, and the product's core philosophy, which has turned many consumers, including Kia, into zealous converts. So, here's my conversation with Jesse. Hello, and welcome back to the Fintech Takes podcast. We are recording this live from the Money Experience Summit here in the mountains of Utah, which is a very beautiful setting. I am absolutely delighted to be joined by Jesse Mecham, the founder of YNAB. Jesse, thanks for taking the time.
I'm very glad to be here. Thanks for having me, Alex.
So I joked about this with you offline before we started recording, but my bank nerd friend Kia Hazlitt is a huge fan of YNAB.
Excellent.
And is a very, very passionate advocate and evangelist of, I think, not only the app, which he really likes, but the broader philosophy.
Yes.
And I thought that actually might be a good place to start because I will admit personally, having dabbled in a lot of different areas of personal financial management, I'm actually not that familiar with YNAB in terms of the origin story and the product. So I was wondering if we could start by you giving us a little bit of the history on why you started the company, the 4 simple rules that was sort of built around, and then we can kind of go from there.
Okay, awesome. I originally built YNAB as a spreadsheet for me and my wife to use.
Wow.
And I had no concept of commercializing it or launching it or anything. It was, we were married young, and we then were going to have a baby young, and we were still in school young, and all of that. And so we just had to really track our money carefully.
Yeah.
And so I built this little spreadsheet. We called it the budget. It worked really well for us. But then when our first was on the way, my wife wanted to step out of the workforce, and I was trying to figure out, honestly, my grand entrepreneurial vision, which is not very grand, was we had to make about $350 of extra money every month to get us through school without borrowing any money. I had 2 years left of school and was going to go off into the sunset as a CPA.
That was the dream.
That was the dream, as is every little boy's dream.
Sure.
Absolutely. So we ended up thinking maybe a couple people would want this little spreadsheet that we had built, and launched it. Spreadsheets have all kinds of problems. So about maybe a year later, I had started to discover the rules that the spreadsheet enforced and kind of perpetuated for people. Like it was kind of forcing a new way of thinking for these users, but it was falling on its face in all kinds of ways that spreadsheets would. So we ended up getting rid of that pretty quickly and built some software. And that was back in 2006. The iPhone hadn't come out. And from there, it's just been this progressive, just riding the wave of technology as it's presented itself. And it's interesting you say your friend is more of a proponent of the method than the app, and I am too. Like at the end of the day, the method, the way of thinking about your money is what we're trying to teach people to do, and the method just facilitates thinking about it. So that's the end. That's kind of the origin story in a very little nutshell, and a little bit on that.
So expanding on that a little bit, can you describe the method at a high level? Obviously, I know there's a lot of nuance and a lot of detail to it, but I think on your website, when you talk about kind of the philosophy, you sort of distill it down to 4 rules. Correct?
Yeah, absolutely. Yeah, the first rule we call giving every dollar a job. It's essentially the idea that you can't have money do 2 things, and everything that surrounds us kind of convinces us that money can be used simultaneously. Like you hear the story of the person that is going to get a tax refund and they've already spent it like 5 different ways in their mind.
Right.
And so money is finite, and this first rule teaches you to kind of get comfortable with, like, if I do this, I can't do that. Not that we're saying you can't do things, but really we're trying to say, what do you want? That's that key piece. The next rule is called embracing your true expenses. And it's this idea of like, yes, you want this, but let's look ahead to the future and think about larger, less frequent spending, whether it's a property tax bill that's not that fun, or it's like a vacation to Italy that's lots of fun.
Sure.
Both of those things are real expenses that people have a hard time considering in the moment. So if I were to be like, hey, Alex, let's go get sushi, you aren't like, oh, we could do sushi, but I also need to repair my car a year from now. No one's making that calculus, right?
My brain doesn't work.
No one's brain does. Like, we're kind of here for the moment. And so this starts to get people to give every dollar a job here and now, but then also think about those true expenses, bring those back into the mix, and still be prioritizing. The third rule is a funny one because we call it rolling with the punches, but it's this idea that like you just set up the plan, you just made the plan, and the next day you should be able to change your plan. Like it's more like a football coach that studied all the film, got the team ready, everything's dialed in, and then they see how the game unfolds and they make adjustments.
Mm-hmm.
For some reason, when we do this with our money, we're like just coming into it and we want to be like clairvoyant about what is going to happen.
Right.
And then our fourth rule is very unique to YNAB, but it's this idea of aging your money.
Yeah.
And it's just this idea that you should be able to let your money that you earn sit for 30, 45, 60 days, kind of depending on a person's personal situation.
Mm-hmm.
But just, we're trying to get people to step away from the financial edge and not be so under the gun on like, you have to make this decision, you have to react. When we're in those situations, it's almost like fight or flight with finances.
Yeah.
And decision quality is poor. Sleeping quality is poor.
Right.
If you're communicating with a spouse or partner, like all of that becomes more charged because you're just so right on the edge. So we really try and get people away from that financial edge, and it just gives them breathing room to be able to really start making good decisions. So that's it in a nutshell. That's about as fast as I can do it.
That was great.
Yeah.
That was great. I mean, clearly you walked through those a time or two. The last one, the age of money one, is a really interesting one to me because I think one of the things that I'm constantly struck by when I look at fintech is we'll build these really cool apps, tools, frameworks that will apply in one area and we won't apply it in another area, right? And so, like, for example, I'm obsessed with Ramp, which is a great tool for businesses.
Yeah.
But the sort of core mechanics of building delightful software to sort of continually find ways to save you money or to solve sort of adjacent workflow challenges in your life, like, why don't I have that from a consumer perspective, right? And by a similar notion, the age of money one kind of reminds me a little bit of the way that businesses think about like a cash conversion cycle.
Absolutely.
Between, you know, money that's going out versus money that they have to bring in via invoices and like stretching that cash conversion cycle. But it's a very interesting visual metaphor of like, how old is your money?
Yeah.
So just to drill down on that a second, because again, I don't use the product, so maybe you can paint a little bit of a picture, but how do you help people sort of put those rules into practice and to visualize some of those things? Because what you're saying makes total sense, but I think for me, I would have a hard time just knowing those rules and then trying to live them in my own brain. Because to your point, like, I don't think about my vacation to San Diego next summer when I'm making this decision, or I don't think about individual dollars sitting in my account and how long they've been sitting in. So how do you help kind of bring those things to life?
Yeah, the software is what does the lifting there.
Yeah.
So our main idea is we need to get the real information in there, what's actually happening in the world, that reality base. And then you, instead of looking at like your pile of money that maybe your bank app tells you, and the bank app's really slick or whatever, and it's like, hey, you have $9,000 in your checking account. That all you know is you have $9,000 in your checking account.
Right.
And what we try and do is overlay an interface where you then take those $9,000 and you're answering the question, what should this money do before new money will arrive? Mm-hmm. And for a lot of people, it's not $9,000, it's like $500 because they're waiting for a paycheck and they're used to kind of having a pile of bills waiting for money, and we're trying to flip that around and have a pile of money waiting for the bills. And so what happens is if you can give people a way to visualize all of the different jobs their money needs to do, instead of it being a $9,000 balance, it's like $200 for eating out, $115 for swimming lessons for a kiddo, and like on and on, pet things for, this. I love woodworking, so it's like, I need to buy this, or I want to buy this or that. And you're seeing it all in one place where you're feeling the trade-offs that you're making. And so then when someone says, hey, do you want to go on this Alaskan fishing trip? You're like, of course I do. But then you're weighing it against like, okay, we have Christmas coming up. We have the San Diego trip. You have it all in context. And what we lack, and where I complain about fintech is so focused on speed that they're a lot of times removing the end consumer, and I hate even calling them consumers, to be honest, but the end user from the equation. They're trying to kind of say like, we'll automate this for you. We'll make it so fast you don't have to think about it. And we're trying to come in and say, automate away tedious things, like doing math. Yeah. But when it comes to like having the person decide how they want to spend the most precious resource besides time that they have, we want it to be something intentional. We want it to be something where like, you and I, we spend an inordinate amount of time earning money, not doing countless other things because we want to earn money. Yeah. And what we're trying to do is say, all that effort that you use spending or earning money, let's take a little bit of it and put some intentionality behind the spending side of it.
Well, so you touched on a couple things there that are really interesting to me. One is I couldn't agree more about the rush to like remove the user from things in fintech, and it's hard because sometimes it comes from a place of like we're trying to create as much convenience as possible, but I think a lot of times that ends up getting blended with it would actually be financially beneficial to us if we didn't have the consumer thinking quite so much about this choice or the user thinking quite so much about this. And like to your point, there is very much a value, I think, to surfacing context to people and giving them an ability to make decisions. I mean, I often think about software as, sort of digitizing and making accessible the types of things that people who've had lots of resources have done for a long time, which is, look, I don't want to do all the tedious stuff, but I do want my accountant to sit down with me for an hour and walk me through all the decision points that are critical that I need to think about. So being able to bring that to a broader base of users makes a lot of sense to me. The other thing you talked about, though, that I wanted to ask you about is speed, right? If I'm remembering right, is it 2001 that you guys got started?
2004.
2004,
Yeah.
okay. So 2004, that makes you sort of old in a fintech context. I don't mean to call you old, but in a fintech context, like you guys have been around for a while. And my sense of you guys just having observed from a distance is that you actually tend to be pretty methodical and thoughtful about how we want to evolve our products. You seem to have a pretty straightforward kind of business model in terms of like a subscription. Can you talk a little bit about kind of the philosophy of trying to stay aligned with users as you build the product and as you sort of think about the business model?
Yeah. We want the transaction between us and the user to be obvious, right? So it's like you pay us, $109 a year, and you get access to the software. And then we have like our data privacy is unbelievably consumer friendly in the sense that we're like, we won't do anything. We aren't going to try and monetize this. We sit on a trove of information, and if you look more broadly at the fintech space, it's basically like data is money, data is currency, and we don't want that. I want the consumer, our end user, just to know I'm paying for this software, I'm getting this access, and that's where the value transaction or the value transfer takes place.
And it kind of holds you accountable for we need to earn that $109
it does,
a year.
It does. And we don't want to make money if the consumer, if our end user spends. We don't want to make money if they save more. We don't want to make money if they borrow. We want to make money because we are facilitating them making killer decisions about their money. And it's a business decision we've made. The end basically. But what we get from our end user is someone that sat there with $300 average checking account balance and now is at $7,000 9 months later. And we have thousands of testimonials of people that say, like, you literally saved my marriage. We couldn't talk about this. We're now on the same page. We have people that tell us they stopped. I mean, not like a few people, hundreds of people have said, we stopped smoking because of this. Like, and we don't go out there and be like, hey, save money by, quitting smoking. But as what you said about surfacing context, that the information is so valuable. And the same reason that these businesses want the data. Like I'm just trying to say, let's give the consumers that some visibility into their own data, their own spending, so that they can really be armed with the best information and say, do I want this or not?
Yeah, no, that makes sense. And I think one of the things that's so fascinating to me about the personal financial management space, which I have spent a lot of time delving into and thinking about a lot, and the business decision part of what you're talking about, I think you guys were ahead of the curve there, because I've seen a lot of the rest of the industry kind of go all the way back around to, wow, maybe a simple, straightforward model where we just charge for our services and that's it is the aligned model that's going to work well here. But the other thing I notice in PFM a lot is, I don't want to say it's a religion or a philosophy.
It's been called a cult. So
yeah, I actually think I've joked with my friend Kia about that in a good way. But the thing it kind of touches on that I wanted to ask you about is, it seems like the more specific and opinionated you can be about how to help people with this, the more it clicks into certain people's brains,
Yeah.
right? And I think the trade-off there is and I run into these types of opinionated products out in the wild all the time. If they don't work for you, they don't work for you at all.
Right.
But if they work for you, it becomes kind of part of who you are and how you see the world and how you think about that. So can you talk a little bit about like opinionated product design and like the choices you have to sort of make there? Because I imagine that you probably get certain user feedback that's like, oh, you know, but this doesn't really make sense to me, or have you ever thought about adding this or doing that?
Right.
Like, how do you parse those decisions?
Yeah, another one that we have is people say, how, support investing more, support tracking my investments, and we don't. I mean, we do the most bare bones. Like, if you want to throw it in there, and literally like almost manual ledger,
right?
You could update it.
Right.
I actually would love to rip that out, but we focus entirely on the person's spending.
Yeah.
And so when you can be so myopic, it's a strength to your software. It makes for better product. Mm-hmm. And so we are just 100% obsessed over the spending. Our market is anyone that spends money. Mm-hmm. And we obviously exclude loads of people that have no interest being so involved with their spending.
Sure.
But there's still enough there where I think, man, there are enough people that they feel like money is a chore. They feel like they want to like do as little as possible. They want to distance themselves from the very thing that they spend so much time trying to earn. Yeah. And so we're trying to resolve that disconnect. Mm. There's some dissonance there for people, honestly. And if the software can help people start to, and I mean this in the best of ways, start to love their money. Yeah. Treat it well. Yeah. I find that it ends up being a level of self-respect. Yeah. That a person has. It translates back into their earning. Like when they're spending well, suddenly when they're out there on the job and they're earning money, they're appreciating it in this different way. Yeah. They're like, I'm not just on a treadmill. I'm not just in some rat race. This has purpose, because they're threading the purpose all the way through a job they maybe even love, all the way through to like how they're using the resources that job let them earn. And that being able to pull that thread of really enjoying the whole process from earn to spend, that's what I'm obsessed about. And if the software can help people pull that thread through all the way, that's what it's going to do. And we won't get everyone, but I think we can get a meaningful amount of people.
Yeah, I mean, I absolutely think you can. And the part of that jumps out to me is this idea of pulling things into the broader context of how you live your life, right? Yeah. I mean, I think the analogy, and we draw this analogy a lot in financial services to physical health and to healthcare, mm-hmm. but it's kind of that same thing where like when you start to see that flywheel get going and you start to be like, oh, actually this thing I did, I felt the impact of it over here, and that's informing my choices. And the choice can even be like, my wife and I had one of the best meals I've ever had in my entire life a couple of nights ago.
Excellent. And
it was amazing. Probably not the healthiest meal in the world, but like there's something about even understanding the trade-off you're making and savoring it when you enjoy it, right? And so that idea of surfacing information and context so that every part of your life, and again, money touches every part of our lives, makes more sense and is in context is a really powerful idea. Two last questions, then I'll let you go.
Yeah, you bet.
One is, and I promised Kia I would ask this question, why haven't banks built this?
Yeah. Banks make money from lending.
Yeah.
And this, as you become more and more aware of your spending, you naturally don't want to borrow as much money.
Right.
And we don't tell people don't borrow money. Sure. We don't tell them feel bad if you have.
This is not quite that religion.
Oh, no, a little different religion. Yeah. We really don't even tell people pay it off fast. I'm going to keep stealing with that phrase. We just surface context, mm-hmm. and people then are like, I don't like that payment I'm making all the time. It's kind of robbing me of some other options. And they come to the conclusion, independent of any guru telling them what they should or shouldn't do. Yeah. And so that's, banks, for all of the ways that they, I don't want to make them sound disingenuous, for all of the ways that they try and be very helpful to their customers, a bank makes money by lending. And until that isn't true, you're just like as Charlie Munger says, the incentives are undefeated.
Yeah.
And so that's what you're doing. I think that's why banks don't do it.
I completely agree with that, and I would add just one point, which is that I talk to banks all the time about new ways to make money, right? Mm-hmm. And one of the ones that I talk to them about that is so simple and yet so like foreign to them is you could just charge for your services. You know what I mean? And this is the kind of thing where like if you offered this thing, maybe you wouldn't have such an incentive to always push people towards lending, but there's this entrenched model in banking, which is the account we give you to store your money and to spend your money on a kind of a day-to-day basis is free. It doesn't cost you anything, which is not actually true.
That's not true.
These things have costs, but it's free. And because it's free, we're not going to invest any more in making that experience better or more tailored to what you might want. And then on the other end, we're going to cross-subsidize that with this thing that's good for us, can be good for you, can be bad for you, and it's up to you to sort of navigate the difference there on your own. So it is very much of a mindset that they're sort of trapped in, and it's hard to get out of. Last question, and this is Jane Barrett would be mad at me if I didn't ask this question, and I think you have a session coming up later to talk about this, but your product, I'm assuming, very much depends upon being able to, I think you mentioned the truth and getting like the reality in the app of like, here's how much you are actually spending, here are your different sources of income. So data aggregation, I'm guessing, sits very central to your product. I did not realize how challenging data aggregation is until I started talking to PFM founders. Yeah. And then my eyes were opened to the world of like coverage, connectivity, you know, such and such bank just got in a fight with this aggregator and suddenly I have, 200 customers calling me going, what the hell? Can you talk a little bit about sort of the current state of data aggregation and how it sort of impacts your product, and then what you think might, or what you even hope might change post 1033?
Yeah. I mean, imagine you own a home and it's like you need it to have like really nice curb appeal, but you have to pay someone else to manage the windows. And those windows constantly break for no reason at all. And you're trying to figure it out. And you find out there are like multiple factions that all have some weird stake in the windows. And you're just trying to be like, I just want the windows to work. And it seems like everyone's trying hard. So we partner with these data aggregators, and it is not for trying. No. Not in the slightest. And we do the best we can. Yeah. You do feel like because you are the end point for a user, you are the one that appears to fall on your face, and it's just something. Right? Yeah, that's just something you get comfortable with. Yeah. And so if a bank isn't playing nicely, you get the calls. It is getting better and better by the day. Yeah, and we are light years ahead of where we were when we initially launched, and we were kind of late to the data ag party, but we launched in 8 years ago. Mm-hmm. It is so much better than it was, and I'm very, very hopeful that it will continue to improve. I think banks need to recognize, and they do recognize, how valuable data is because of how they talk about it in every other way possible. And so when you are recognizing something that you own, this flow that is so unbelievably valuable, it starts to appear to be like the flow of water or the flow of gas or some kind of utility. And that's where you're starting to see a lot of kind of public good interest looking at it like, listen, we can't just say, hey, listen, it's that entity's data. It starts to become so valuable and so important that it has to be treated almost like some kind of a public right-of-way situation. And that's where my expertise completely ends, navigating that. And that's where Jane's begins, I think. But we are just there hopeful that the end result for the consumer is they get the data they need. They get it at a speed that is tolerable in this day and age, that it's reliable, and so they can surface all the context they need to make good decisions. At the end of the day, it's a precious thing that they have there, that money. It's a little representation of them in that bank account. It's all of their effort and blood, sweat, and tears all sitting in that bank account. And it's important that we let them know what they're doing with essentially themselves at that point.
Yeah, it's a reflection of what you're doing on a day-to-day basis. That is a great place to leave it. Jesse, thank you so much.
Thanks
this
for having
was
me.
A delight, and now Kia Hazlitt is incredibly jealous, which makes me happy.
Yeah, absolutely.
This was great. I really appreciate it.
And last but absolutely not least, we have MX founder and newly returned CEO, Ryan Caldwell. I'd never actually met Ryan until this interview, so you can imagine how many different questions I had for him. However, we didn't have a ton of time, so I decided to focus our conversation on culture, because more than anything else, that's what stands out to me about MX, the company's culture. And I wanted to understand from Ryan, who, as you'll hear, is deeply passionate about this topic, maybe even more so than data aggregation or open banking, how he thinks about building and maybe more importantly, maintaining culture in an age when everyone talks the talk, but few actually walk the walk. I really enjoyed this conversation. And so to wrap up today's podcast, here is my chat with Ryan Caldwell. Well, welcome back to the Fintech Takes podcast, recorded live from the Money Experience Summit in the beautiful hills above Park City, Utah. I'm joined by Ryan Caldwell, the host of the MX Money Experience Summit. Thank you so much for having me out here. This has been a lot of fun.
Thanks for making it up.
It has been my pleasure. In fact, this has been my favorite fintech event to go to for multiple years in a row. So I'm a huge fan, and should mention, in addition to co-founding MX and being CEO, you were recently returned to the role of CEO. How's that going so far?
It's going great. It's only been a few months, but it's been exhilarating. It's a rare thing when a founder steps away from a company and then gets asked to come back. I would have never stepped away from MX if it wasn't for the health issues that my daughter had. As we all know, family is what's most important.
Yes.
And so that pulled me away from the business. But as she started doing better and better health-wise, still a long ways to go, but better and better health-wise, and as all family things stabilized and calmed down, I started spending more time back in the business, a little bit here, a little bit there. Still executive chairman and still involved in a lot of strategy of the business for little parts of the business, because obviously I took a pretty big step back as I fully focused on family. But as I started getting more involved in the business, it was really clear that the next phase of what we had always planned to do, that we were on the precipice of, that we could go a lot faster and more disciplined focus in how we might be able to execute there. So as that became clear, the board asked me if I'd return, and with the I was very thankful to have the support of my wife and my family.
Yes.
And so I was able to come back, and we're off to the races building. It is exhilarating. It is a lot. There's so much to get done, but we're having a blast.
Well, that's awesome. First of all, I'm glad that your daughter is doing better.
Thank you.
And I was curious, actually, since you mentioned it, to just ask, having had the opportunity to step back a little bit, I'm curious what you found or maybe what you learned about MX, about sort of strategy for a company, or thinking about growth, or thinking about the future, given that you weren't in the day-to-day quite as much. I find, for me at least, one of the things that's really hard is it feels like it's a different part of your brain when you're sort of in the day-to-day grind of doing things. And I would think perhaps it would give you a different vantage point to be a little further away. What was that experience like?
It did, but what's probably, I'll touch on that in a second, but I think this is kind of part of your question.
Yeah.
But the thing that hit me the hardest by far, the biggest impact that really I saw clearer than I'd ever seen before, was how much culture mattered. Like I always, the funny thing is,
you mentioned that actually,
yeah. The funny thing is, you would have thought, talking to me for 10 years prior to that, you would have thought, well, you already cared about culture to the highest level. I'm like, right. I already believed it was one of the most important things in a company. I was so oriented towards strong culture, meaningful, purposeful culture. Yeah. But even then, I didn't understand how important it was, because seeing how even the little bit of drift in culture changes, our ability of how we even think about delivering for our clients, delivering for their customers. Because we don't just care about our clients, we care about their customers. How we take care of each other as a team, how we hold each other accountable to the highest levels, and also how you have a blast doing it. I mean, one of the interesting about MX is, like, we're one of the hardest working teams that's out there, but we have more fun than almost any other team out there.
I can attest to this, yes.
Right. People who come and spend time with us know that about us. And we became almost famous for that. I mean, there's articles written in national magazines about our culture and how our culture changes outcomes. And we had so much pride in that. And watching that even drift a small amount, it changed outcomes. It changed. Now, part of that culture is very candid, almost brutal honesty, but brutal honesty with a heart.
Yep.
Do you know what I'm saying?
I do,
Like,
yeah.
and one of our values is being cognizant, but we believe in objectivity and discourse. So we're going to be objective. We're going to use facts and data as we talk to our customers or our clients, our partners, and each other inside the company. But we're going to be cognizant of that's a human that may have been working on that project for 2 months. And you got to be honest that it's a little sideways, and we got to fix these 3 things. But they also put their heart and soul into it. So there's such a beautiful balance in the values at MX of how we can have extreme objectivity and discourse, founder mindset, foundation of trust, but also have cognizance. And so those things matter. So for me, being away and then coming back, it was just like, okay, I never could have imagined with how much I talk about culture that I even misunderstood how important it was, because I always knew how important it was. So that was the number one thing of being away and then coming back that just hit me hard. So I would say that's probably the biggest takeaway from being back. Now, as far as being invigorated, where I was like, okay, I can now see something different. I think it really pained me to see how close we came to not just connecting to great data and enhancing it in the most beautiful ways and then creating great insights, but we were right on the precipice of creating action. And that was something where it pained me over the 2.5 years that I was away to see us not complete that next step that we were so close to. And that's what has me the most excited is the whole team. I mean, we're in product meetings even yesterday morning. I had multiple, and just seeing all the hard work that we've built, this huge foundation, start to have huge impact on action and driving change. That's been rewarding.
All right, so I wanted to talk about culture because MX is, I think, one of a handful of companies that I work with on a regular basis and talk to on a regular basis where I actually do feel a tangible culture, right? Everyone talks about culture, and I don't think it's necessarily all empty talk, but I think one of the things I've come away from the sort of discussion on culture around is it's much harder to actually build, strengthen, maintain, stop from drifting than I think people think, right? I think it's maybe seen sometimes more as if we do 5 things at the beginning, that will set the foundation for a culture, and it's like a tree that will just grow in the forest, and we don't have to pay attention to it. It'll all just be fine. And I think what I hear you saying is that it's actually a series of very small day-to-day choices that you make every single day at every level of the organization. And I'm curious if you could maybe elaborate a little bit on some examples of how that works and why it's so hard, right? Because I think one of the things that I always hear people talk about, but I never hear the other part of it is we really value this, we want to do this. And my follow-up question is always, okay, what are you going to give up to have that, right? We can't have everything we want. So how do you make sacrifices or make hard decisions or do things different to really protect and nurture that culture?
Yeah. So, culture is so fascinating. My opinions of this have always been strong. They've solidified even more. What's interesting is, yes, you foster culture, but one of the main ways in which you foster culture has to do with the people that you hire.
Sure.
You can't hire the wrong people. And when I say the wrong people, I don't mean permanently the wrong people, because it can be the wrong person at that time. Right. It could have been the right person 10 years ago or 10 years from now, right? Or 2 years from now. So, but it's people who are at that right moment in their life when they want to lean in and build something great, and they're oriented towards that. So if I use this tuning fork analogy. So one of the ways in which we hired for the however many first years of MX was we got clear on what we were, what we wanted to do. There was no ambiguity. We wanted to use financial data to empower the world to be financially strong. We knew why that was important to us. We believe that finances power all of the most important and tangible things in your life, like your family, like your health, are either broken, empowered, protected, and provided for, or derailed based off of where your finances are.
Yeah.
And so finances are really, really important. So we got clear on why that was important. We also got into the deep stuff of look, if you don't have upward mobility in a society, if you don't have a strong middle class, you can't have a stable democracy. Like to have a stable democracy over a long period of time, you have to have upward mobility. People have to believe they can have a chance to win in the economy, especially if it's a capitalistic democracy, which I'm a strong believer in both. And so we needed to have that. Having the ability to manage your finances in a way that gives you a chance to have that upward mobility is key to democracies being stable. So we believe that. I mean, we believe in our core that we're not like, oh, we're kind of connected data. We power some few fintechs and whatever. Like, no, the banking, there's nobility. We've always had this. We have whole talks about there's nobility in banking. We believe that banking is critical to having a thriving economy, and you need a strong, diverse, a resilient banking sector that can empower the rate of innovation you need to have a thriving economy. So all of that we believe in. So that's what we believe we were. So our mission was clear, the impact was clear, and so we got clear on our values. This is how we're going to have objectivity in discourse. We need to be able to trust each other. We want to work with people who are founder mindset, where they're like they feel like they have ownership skin in the game. Right. So we got clear, and we want people who are also, exuberance for life is one of our values. We want people who, it says in that value, a big paragraph describing what exuberance for life means. We don't like people who are jerks. We want people who are going to work hard. They're going to have fun doing it. So as we described all these values, that's what I call our tuning fork. So then we strike that tuning fork as loud as we can, and it just starts vibrating. When people come in for interviews, I'm not sitting there like, okay, give me your exact qualifications and your resume and your LinkedIn profile. Oh, that's impressive, your experience here. What I'm looking for is, do you resonate with how the core DNA of who we are? It's interesting is you don't have to force it. When someone comes in to quote unquote interview, I don't like to call it interview. It's discovery. We're figuring out who you are. You're figuring out who we are. Either you can feel the resonance or you don't. Like when you move, when you strike a tuning fork really loud and you move it next to one, if it in its DNA has the capacity to resonate, it starts to resonate naturally, and you have this meeting, not an interview, but like a meeting where the excitement starts to grow, and that's how we built our team. So what happens over time? Why does culture shift? Culture shifts because as the company becomes that team can't help but be successful. It's going to do incredible things. As they become successful, the whole company becomes exciting to everybody else. And as a company starts to scale, people are saying, I want to see it on that ship. I want to see it on that ship. But the people who can kind of navigate and jump from career to career to find the best thing between companies, but they're not invested in really building something great.
I was going to say they're resonating at a different frequency.
They're resonating for the wrong reasons. They're not resonating because of the values they actually like. They're resonating because of the dollar signs of that company's valued really high, or that company's going to do something great. That company could help my career. So they're attracted for the wrong reasons. But they'll fight to get in. Right? So now you have to be more disciplined than ever in your interviewing process and in your evaluation and performance process to make sure that you're taking good care of the people who are the builders. And what's interesting about the builders, I'll give you a great example. The people who come in for the wrong reasons are experts at advocating for themselves. The people who are builders don't almost ever advocate for themselves. So if you don't have a culture that is meritocracy based, where you reward someone whether or not they ask for it based off purely merit, and you also don't reward someone because they're complaining in a squeaky wheel, then it protects that culture. But that's really hard to do because as the company becomes more and more successful, and people want to work there and be there more, people start to find a way to like fight their way in. And so you have to get your need to be resilient in the early days is less. Because you're just a little company, right? But then you get more and more exciting over time, and then you have to build up a little bit of a shell to protect these great people on the inside. And when you see that drift a little bit, because here's what happens is when you get somebody from the outside that works their way in, that isn't a builder or a creator, they exhaust everyone else around them. Right. And so you can see how you have to be very protective of the great builders and the creative people and the minds and the constructive people. You have to really be thoughtful about how to protect that culture.
So speaking of being thoughtful about that, I think it sort of bridges into like business strategy type stuff, right, as well, because one of the other things I find fascinating about this whole space is there are lots of different ways to attack it. And one of the things that's always stood out to me about MX, and I think is really interesting, is you guys have taken for a long time, and I think it has to do with the roots of your product and kind of where you started, but have always sort of taken the approach that, like, as you said, banks are critical to the functioning of the economy, to lifting people up, and we want to empower banks to help people do that better. And it's interesting because open banking is one of those topics where, depending on who you talk to, people are either very big fans of it or they're sort of resistant to the idea for some reason. And I'm curious if you could kind of talk a little bit about, particularly as maybe you guys took the longer path to get to certain places rather than the shorter cuts, from like a business strategy perspective, and picking which types of clients you want to work with, and who's a good fit for the vision that you guys have, and trying to build things maybe slower but in the way that seems right to you. Like, where were some of those trade-offs or those forks in the road? Because I think to other people who are listening who are maybe thinking about the journey of like what happens after you get that 0 to 1 momentum and a startup, like the what comes next part is the part that I think we don't maybe talk as much about, but there's some critical choices there.
I think it's very tempting for someone building a startup to look for the quick wins. And it's enticing. I get it. But if you really want the change to occur, right, your concern is not, your concern is building a great business with incredible fundamentals that really delivers actual value. That's a different journey than building something that just looks like a shiny object. Right. And real builders and real creators, getting back to that cultural element, those people, they want to know that their work matters and they want it to echo. So they're not focused on, they, like anyone, they would love to have a great outcome at some point.
Absolutely.
But they're not obsessed with that, and they're fine waiting for the outcome and having the outcome even be bigger. Because what happens if you build it right, your actual outcome long term can be much, much larger because you're building over a longer period of time. If you're oriented towards the quick win, the chance that the company can get corrupted from the inside out or just be hollowed out and just kind of collapse in on itself goes up. And that's a real risk. I mean, if the culture shifts too much. And so we've tried to be very thoughtful about understanding long-term banking is critical to the innovation of a country. The best banks will win long-term. We're the biggest believer in it. And when I mean the best banks, I mean banks that are advocacy-based. So we don't want to engage with a bank that isn't going to use the data to drive great outcomes for the consumer and enrich their lives financially. We don't empower them to be financially strong is one of the sayings that we use a lot. If they're not going to use the data that way, then we don't think they're going to be successful long term. So we're not that worried about getting them as a client. We want the banks that are saying, we know we can make our consumers' financial lives better. We know we could do more. How can we do more? And we're like, great, we're going to help you do that. And we're going to drive your revenue up. And we're going to drive your profitability up. Because in a modern paradigm, the loyal customer that can just trust that entity, that bank, or that retailer, I'll use Amazon as an example. If I know that every single time I get a product that I'm like, this was complete crap, and Amazon makes it completely easy for me to return it, then every time I find a product on a third party's website, I'm like, I don't want to deal with it.
I don't know that I want to do this.
I'll literally cut and paste the product description, dump it into Amazon and say, does Amazon have it? And if Amazon doesn't have it, they'll show me something close enough and I'll just buy that.
And that trusted infrastructure is what you're optimizing for.
Right. So if you're a trusted bank, where like, hey, that's the bank that's going to take care of me. I think about, let me use an example of this, by the way, works across banking. Here's a bank that also does insurance, USA. I'm a big fan of USA, always have been. I had a USA account from when I was 17, went into the Air Force Academy at a young age and got a USA account. So I've had USA insurance for a long time. I won't ever go with other insurance. Right? Because I don't know, I have such a relationship with USAA that they take care of me in the rare event that there's a wreck. And I, in fact, most recently, I had someone who 5 seconds late ran a red light and completely collided with my car. I wasn't at fault at all. And I just love that I'm in such good hands with USAA. So they get my business. Right? I default to them. I don't shop around when I get a new car. I don't shop around. I don't worry about anything. It's like, just take my business. Right?
Well, I've talked about the idea that in the future, from a sort of portability standpoint, if everyone can move around and it's easy to shop for prices, and maybe we have AI helping us like do perfect product discovery, the goal is going to be you want customers to overrule their AI and go, I know you found something that's a better price, but I value this other thing that I get from USAA that has nothing to do with that. And like, that's the future banks need to be prepared for, right?
You've nailed it. That is exactly the future that we've always believed in. So because we believe in that so strongly, that if we can help a bank be that trusted brand where the user just defaults to, I know I could probably get like, oh, we'll save you this little bit on this auto loan, we'll save this little bit on this credit card. You're like, maybe, kind of, sort of. I don't trust it. I'm good with where I am.
I value my relationship here.
Right. like every time that I reorder something on Amazon, I don't go double check the pricing because I was curious for a while.
Sure,
and I'd
sure.
go check and
Yeah,
I'd find, it really is cheaper than anywhere else. And
Right.
and I was like, so I kind of most of the time don't check anything.
Yeah.
Right.
Yeah.
And so that's the power of a trusted brand. And even when they'll find it like a few cents somewhere else or $1 less or whatever, who cares? It's so much
Right.
easier with Amazon. Just do it.
Right.
So I think the banks that are going to make that extra bit of margin
Mm-hmm.
are going to be because they're so trusted and they've got great, and then they'll also get greater share of wallet.
Yep.
They'll get all of those things. So this data can help drive that because the bank can now guide the consumer towards better outcomes, can protect them from all sorts of issues.
Can be an advocate for them.
It'd be a complete advocate. So that's fundamentally how we view the future occurring. So then that translates into, well, who's going to win, the banking or the fintechs?
Yeah.
We believe the best banks will look more and more like advocates for the consumers, like fintechs,
Yeah.
and take the best aspects of fintechs and integrate it into their banking experience.
Yep.
Be very involved in their consumers' lives in just the right amount to not bother them, but to guide them. And then the best fintechs will say, hey, we want access to super low interest deposit dollars. We want to use ratios to be able to lend out money.
Access these payment rails.
Right. Yeah. We want to. So it's like they're making more and more like a bank,
Mm-hmm.
get a little bit more and more under regulatory scrutiny. And we'll see the best fintechs and the best banks will essentially become more and more like each other and eventually will become indistinguishable.
Yeah.
And we're seeing that with essentially neobanks or a version of that.
Yeah. Absolutely. Well, I could keep going and going, but I know you're a busy man. I have to let you go. Thank you so much for carving out the time. And again, thanks for a lovely venue for this conversation.
No, thanks for making it out.
Absolutely.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.